Perfect. Um, Ladies and gentlemen, welcome to our podcast that is the Malemo Conversation Space. At the Malemo Conversation Space, this is the only space where we bring you exclusive information, exclusive data that can be able to be used for your day-to-day, that is understanding of how your economy, how your social life, how you everything that is around you, how is it moving, how is it doing, irrespective of where you are, and it is so exclusive. I want to assure you that on this podcast, we are not going to be able to bring to you the very people that you know. But just hold on. Why should you listen to this podcast? Because it is more interested in information than more being interested in who do you know. So information is what can change your life, not who do you know is what can change your life. Networking is very important, but where are you networking? The person you are networking with, what is the vision of that person? How does he perceive your network? Is he really willing for you to network? Because going to a meeting, going to a conference to be able to maybe have maybe to be able to have a networking session is so nice and it's really good. But the big question is the person you want to network with willing for you to network with? And is he in the capacity of being able to network with you? So for us, we believe that apart from having a network, or besides having a network, having the right information counts more than having that network that you need. Because what will benefit if you have a network of someone who is known and is maybe let's say this person, maybe the information he has is not leading to maybe what you want. So we break the monotony and we break all the odds of understanding, where every podcast for you to watch, you must be able to see, and who is that undertaking that podcast? Do I know that person? No. We want to bring to you exclusive content regardless of the faces besides the podcast. So what is important is the information you gain. And I want to assure you that on this channel, we will be able to dissect these matters slowly, and we will ensure that you're getting them as far as you are supposed to get them. So support us, stand with us, subscribe to our channel, share and like our channel. We will be able to, as you continue liking, we will be able to grow and bring you more and exclusive content. So our interactions today, we want to be able to focus on tax and tax under the value added tax. Value added tax. What is a value added tax? First, value added tax, it is a tax that it is suggested to fix the problem of turnover tax. Value added tax, this is where you have a product in a farm. You have harvested a product in a farm. A person purchasing that product in a farm for consumption at the farm, that person does not pay value added tax. Why? Because the product from your farm has not undergone any process whatsoever that warrants the government to be able to attract a tax, because there is no value that has been added on the product. Nevertheless, you have harvested, you have a processing plant, you have a manufacturing plant, you have a storage or a cold room that you're supposed to process your products, be able to push the products to that place, maybe for storage purposes, maybe for processing purposes. From your farm to that place, you are adding a value on that product. I want to be able to ensure that you understand how does value added tax come in. So the process of you ending up with a product in a processing plant, that product, it changes tune from just being a product to a value added product, because it has gone under if it is It is a grape and wine. For a grape to be able to qualify to be wine, it undergoes a process called fermentation. So it's like fermentation. It's adding value to this grape to be able to come out with a wine. So we are saying in the process that the constant, or let's say the variables are undergoing a process where this produce, as at the farm, it was maize for just consumption, maize for just ugali, but it has ended up from being just maize to being a maize flour packed in a 2 kg packet, or in a 1 kg packet. The process of packaging, milling and packaging, and ending up in a shelf, it is value addition. That is where, for you to be able to have a lot of tax to be collected in an economy, and it is subscribed to value added tax, because of course value added tax is not a generally accepted tax, because it is tax that is charged by specific countries, not all countries in the world. So there are specific countries that subscribe to value added tax. So we are agreeing that value added tax, this is a tax that is charged on items, on services that have undergone a process to be able to have been added some value. That is what we will come in and call value added tax. Value added tax, the history of value added tax. Value added tax was introduced first in the world in 1919 by the German businessman. This guy was called someone Siemens or whatsoever. The reason why Siemens, Wilhelm or von Siemens, introduced value added tax in Germany, it was to fix the problem of turnover tax. So it was first introduced 100 years ago, and it was introduced by a German business person. What was he trying to do? He was trying to solve a problem of turnover taxes. Turnover taxes, by that time, they were somehow, there was a problem of calculating this turnover tax on sales at the end of the year and being paid on a monthly basis. And what did Vaughan want to achieve? Vaughan in 1918 viewed value added tax as it's not a progressive tax where you are going to pay tax that is calculated on a yearly basis, but the government wants to collect on a monthly basis. So Vaughan wanted a system where, for you to sustain a government or for you to sustain a business, because he was a businessman, he wanted that this product that has undergone a value, let it be charged a VAT, but this VAT, let it be charged on a monthly basis, so that we fix where revenue is now going to be collected on a monthly basis. Then that was now then just it wasn't well structured. The structures were not well put, and they were not that well conversant with them and how they were moving and how they were doing. They were not that so important. So in 1954, there was a Frenchman who was called Maurice Laure. Maurice Laure in 1954, who was a French, he implemented the modern VAT in 1954. And it was so bad that he is a French person or a Frenchman. He pioneered it. Pioneering means he undertook some tests on this value added tax, but he did it, the first value added tax in 1954 for modern world. It was pioneered in the Ivory Coast by a French person called Maurice Laure. So modern VAT is founded in Africa, in Ivory Coast. We will dive into that history when that time comes. And by that time, Ivory Coast was their colony. So they pioneered it under their colony. And we want to agree that now, value added tax, it was started in Africa. Oh my. Oh my. And value added tax by that time, every business was there was a way you could evade tax by that time. But when they pioneered it in the Ivory Coast, the reason why these guys felt that it is well very much thoughtful, much in order for them to be able to charge this tax is because the business people, as at that time, it was easy for them to evade tax, because for turnover tax you were not supposed to you were the one who was to calculate the total number of sales, then be able to calculate the 1% on the total number of sales to be able to come up with a turnover tax. But with VAT, for you to get aggravated or for you to claim that you sold a product that is value added in nature, you are supposed to have that is an invoice. So for you to claim the credits, it was hard to evade, because for you to claim a credit, you must have an evidence. So it performed perfectly well, and it is performing fast in Africa. That's how we are viewed, and we will come back there. There's another topic of how Africans have been used to attain the modernacy of the international market, but at the same time being left behind and look like we are helpless, we don't have a formation, and we don't have a life, which is so bad and it's discouraging. But anyway, we have our leaders who speak. In Kenya, value-added tax was first introduced in 1990. It exists. There was an existence of a tax called sales tax. Sales tax, this was a tax that we will charge you on sales. Either you've sold any item that you're selling, we will charge you on sales. So we will come at the end of the month or at the end of the year, look at your book, what are the sales you have sold, and we will be able to calculate and maybe tax as it's supposed to be and do our things and go. But the government said, look here, value added tax is where the government and where value added tax is attained in the right way without ambiguities, it helps the consumer to get a product that is viable. It protects the consumer. Let him pay money. That money that he's paying is for a value that has been added on that product, but done in the right way. So VAT is supposed to sales tax. It wasn't caring about what item were you selling, because for you to tax an item and declare that is a processed item, it must have undergone the relevant and necessary processes. But at the sales as at the sales tax before 1990, the sales tax, we were calculating just any sale that you've done, either a product that needed to go through the factory for it to have some preservations and whatever. None of our business. You just pay as our sales tax. You've sold, you've had sales, we are coming for tax. But for VAT, that is for value added tax, it is supposed to protect the consumer from getting the right items. That is by ensuring that the value that has been declared as being added, for you to be able to pay for it, because you, for 16% that you're paying, you are paying for the value that has been added. You're not paying for the tax to the government to just collect, because it is the prerogative of the government to be able to collect tax. It is about what is the value that has been added. So if the value that has been added doesn't add up, then it becomes somehow somehow convincing. So for you to be able to pay that tax, you must ensure that there is value that has been taxed. So it is started as under the Value Added Tax Act, that is Cap 476. Value, not value, but Value Added Tax Act, Cap 476. That is where they introduced something called value added tax in 1990. There has been progressive improvements on the cap, amendments on the value, and all other things until in 2013 they came up with something called Value Added Tax Act 2013. Under the Value Added Tax 2013, because initially that is at Value Added Tax Cap 476 that was introduced in 1990 to modernize, because initially you were to pay between 17 to 18%. But briefly, because of I think introduction of now the 2013 Value Added Tax Act, we standardized VAT at 16%. In 2020, because of COVID-19, it slightly dropped by 2% to 14 to caution maybe consumers. Someone will come in and say, but what happened around 20? There were amendments that lowered the value added tax by 2%. So as at 2020, it was lowered by 2 to 14. Then it came back. That is after the period of COVID-19, it came back to 16%. There has been a lot of reforms in the value added tax system, and if I'm meant to remember so well, is there was introduction of value added tax on digital services from abroad. So they assumed that this thing is not, you're not operating under our market, and there are consumers who are supposed to consume your products, and are these the products, the value that you're giving your products to our citizens, you are supposed to pay this value, because we want to protect them from content that they are consuming. So this it includes Netflix and Google. But with Netflix and Google, under the 2025 tax amendments, they released the consumer from paying that tax, and it is now the Netflix and Google which is supposed to pay that tax to the government. But all the same, it is not making sense, because at the end of the day, they will hike that price and they will misuse you as a consumer and be able to get money to pay for their governments. So there were exemptions. There were exemptions that were amended. We are just still on the history. There were amendments that were done. That is, some health items like mosquito nets. They were moved to exemptions. We will come to exemptions and what have you. But they were moved to exemptions. That's mosquito nets and other medical requirements. Then refunds and rules for bad debts as of late 25 were standard rate remains at 16%. Then VAT credits, you cannot claim them past 5 years unless you need an extension, and the only person who can make extensions, it was moved from Parliament to the CA's National Treasury. So it is a mandate that rests with one person, who is the CS, who is supposed to undertake approval for extension of claims for credits. We will come to credits. So we have started the history of value added tax, and that is what it is. So someone may be able to ask that And who pays value added tax in Kenya? Value added tax, this is the only tax where the burden is transferred from the processor to the seller to the consumer. The burden of tax is shared. So every person pays his bit until it reaches you, who is now supposed to pay the 16, who as the consumer. That's why we were saying this tax is supposed to protect the consumer and ensure that the consumer is consuming products and items that are certified and they don't have issues, maybe that is free from contaminations and whatever. So tax, value-added tax, it's a tax that the manufacturer, as he manufactures, he pays his own tax. Then he charges the wholesaler at 16%. The wholesaler charges you also at 16%. That's when we come in with something called the tax inputs, VAT inputs and VAT outputs. Under the VAT inputs, as a consumer, as a wholesaler, this is what you must understand. And these are things that people who handle taxes, they don't speak. Me, as a person who is purchasing an item to be able to sell to the next available customer, I will buy this product that is a dealer. Let's say I'm purchasing a laptop, or let's use a laptop. That person will charge me 16% on that laptop. I'm the purchaser, so he will be able to charge me 16%, which will be used as a VAT input into my business. I've purchased that laptop at 155,000 or 150,000. I've been charged VAT. So the 115,000 is VAT inclusive. VAT inclusive charged, and I have paid the 16% to the distributor who has given me the machine. I have the next client. That next client, when he comes in, I'll be able to take the 55, which was inclusive of VAT, add my profit. After I've added my profit, and this is where we get it wrong. After I've added my profit, it was already 16% inclusive. So I will just add the profit, then be able to give that person another items receipt. That is to him on the 155, which was inclusive of tax, and I've earned a tax input from the person who sold it to me. As I continue to sell, I will sell to that person and be able to get what we call a tax output. And then that is inclusive of the tax. And then once you have charged this, once I've charged this VAT output, which is on sales, and the VAT input is on purchases, then someone comes in and asks you, how much tax are you supposed to pay? You will not be able to pay the 16 that you charged this person, and you will not be able to pay the 16 that you charged this other. You will be able to pay the 16 that you are charged on the 155, and then the 16 that you charged on your sale, inclusive of the one that you charged on 155, you will get the difference. The difference that you get is now what we call VAT payable. So you have a tax that you've introduced in your business, and you have a tax that has left your business. So you take a tax that has left your business, which is always more because it is inclusive of your profit. It will be much higher because you are a seller. So if the one that you're selling will be much higher. Then the one that you received will be much lower because you are purchasing it without the profit that you will charge. The seller, you will charge him more high because you have profit you are supposed to scoop. Then this one that you brought in, it is lower because you purchased at maybe a wholesale price. Then from there, you will be able to take the one that left your shop, which was higher. You will less the one that ended your shop, which was less. Then it brings us to a conclusion that VAT payable, it is tax, you take the tax inputs, you take the tax outputs, you less the tax inputs. The difference that you get is VAT payable. Then someone proceeds and asks, I deal with several items and I bring in my packages as large packages, or maybe let's use a lighter term as bulky items that I'm dealing with as I do my sales. Then he asks, what will happen to that? So you will have brought in this package, but it has been charged VAT. Then you will be selling them and distributing them slowly by slowly. And VAT is payable every month. So at some point you will get yourself that you are going to get a negative as VAT payable, which it is called a tax credit. Tax credits, these are negatives that accrue or they arise on you filing that VAT as of 20th of every month. This is what happens. It is a negative this month, and you're not going to be able to buy any other stock that will come in. So this means next month you will still do a sale on the stock that you received this month. So you will leave that negative there. When you come to file tax, the tax liability that you get, the negative might, if you get another negative, it will grow. But if you get a positive, it will be able to cancel each other. Because last month, the stock that you received, you didn't sell the whole of it. But it's in the system, tax has been charged. And once you received it, you sold half of it, which it has given you a tax credit of, let's say, 100,000. So next month, if you get that the tax payable is 50,000, it will be that tax credit of 100 settling part of the 50, and then remaining a tax credit of 50. So what we are saying is value added tax, it is calculated at a rate of 16% on VATable products. Then we have products that are zero rated. It's at the finance bill level, people are making a noise that why should you move an item from a zero rated VAT to an exempt? An exempt means the tax burden has been defunct. You cannot be able to claim a credit on an exempted product. An exempted product, this is a product that the only record that KRN needs to see from you is to be able to see that you sold this product and you are dealing in this product and it's not a valuable product. But on a zero rated product, this is a product that can work for the advantage of you as a dealer who is selling that product, because for a zero rated, it can lower your tax burden because you can be able still to claim a tax. You can be able to claim a sales input from that tax. So you can be able to claim that you can be able to claim a tax input, and as we have agreed, is that a tax input reduces your tax liability. So once you have a tax input, your tax liability must come down. So if there is a class on VAT that allows you to claim a tax input from it, that class, it is going to save you from paying tax. So we are saying that tax exempted items have no capacity for you to claim an input nor for you to pay tax from that product. But a zero rated product, you don't pay tax, you as a dealer of that product, but you can claim an input from that product. So that means if you move an item from zero rate to exempt, it becomes a bit noisy, because you are saying that you as a dealer, you will not be able to get a tax input from this item, especially if you're getting it from the manufacturer who has done a value addition, but it is under zero rated. He will be able to pay the 16 on your behalf because you're going to get an input VAT from that person. So it will end up reducing your tax liability. So if it is moved from zero rated to tax exempt, in nutshell or in short, they are telling you that your tax burden from these items, if you are dealing with them going forward, it will not be interfered with. So you will pay tax as prescribed. That is the reason why people are making noise on movement from zero rated to, but they are beneficiaries. That is, a manufacturer is benefits if it's fully tax exempt, but the person who can claim inputs is the one who is now at stake. So we have three categories. We have a tax exempt, we have a zero rated, then we have a VATable under Value Added Tax Act 2013. Read together with finance bill of every year. And by the way, someone might ask, what is a finance bill? A finance bill is always a document that prescribes, changes, adds value, removes, reintroduces, refocuses, reshapes the tax laws that exist. So every time there is a finance bill, it must touch on the Value Added Tax Act of 2013. Because there are loopholes that they will see. They will introduce, ETIMS was introduced through a finance bill. They will introduce stringent measures, strong measures to curb forgery, to curb maybe leakages, tax avoidance, and what have you. So it is, a finance bill is a set of regulations that are passed through Parliament to be able to improve the efficiency of the existing tax laws. And when we say tax laws, Value Added Tax Act of 2013 is just one of it. You have Turnover Tax Act, you have levy, housing levy, which is also a tax because you pay it under KRA. You have NITA levy, you have all those tax regulations and rules and acts. They are stringent and they are ratified, improved through a finance bill. So who is this person that is eligible to be able to register for what we call value added tax? Any person who is having a turnover sale of above 5 million in Kenya. Once you just hit the 5 million mark upwards, you qualify to be able to pay tax and register for VAT. This is where there is a catch. If you don't register for this obligation, it is called a tax obligation on your Kenya Revenue Authority personal identification number. If it's not added and your turnover sales have been turnover above 5 million for 5 years, you will be charged backwards. And this is the danger. As at that time, your obligation for personal identification number was not due as at that time. So when they begin to charge you, you will not have inputs that were credited on your PIN to be able to settle the outputs that has been debited on your PIN. So it will leave you in a sorry state where you will be able to pay a tax burden clearly as it is without inputs, because it is inputs that will reduce your tax burden. So what do we encourage and advise? We encourage and advise that it is good. You just, once you know that my sales turnover rate is going to be above 5 million, or I'm dealing with the items that are VATable, just go and register for that tax obligation. Because working with it backwards, it will be hazardous and dangerous and what have you to you. Because as at the time of calculation, if the PIN is not actively registered under VAT, that PIN cannot be able to credit an input tax on the PIN. So as at the time of calculation, it will be clearly forged and it will be clearly declared that you're going to pay that. That's the reason why you get someone being slapped with a bill of 300 million in terms of tax, because he was purchasing but there were no corresponding ledger under his KRA where the tax inputs could be credited for it to be able to lower the liability for him to be able to pay tax. Goodness. Then we have someone who voluntarily, you purchase items on a daily basis that are VAT charged. And as a consumer, you're supposed to be protected. So if I'm paying VAT and I just volunteered, you just volunteer, and then you go to Kenya Revenue Authority, you can be able to register. So you have those people that they volunteer maybe to be able to register for VAT and what have you. Any foreign company operating in Kenya, it is a must. It must register for value added tax as long as it's a foreign company, any foreign company. As long as you are foreign, you are supposed to register for VAT. That is as per the requirements. So you must be able to know and see. So we have non-residents who are supplying digital electronic services. They must register regardless of the turnover, even if the turnover is 500. But you supplying digital electronics services, you are coming from Dubai, you are coming from Somalia, that is, you coming from Geneva, you selling iPhones or what have you, you are supposed to pay, or you're supposed to register for tax and what have you. We agreed that records, and this is very important, you must maintain records for VAT file in your business, in your premise, for a period of 5 years. You must do it for 5 years, because in case Kenya Revenue Authority decides to revise it backwards, they will revise it backwards for 5 years. Any period extending 5 years, you are protected by the law. No one should come to you and tell you that you evaded tax 10 years back. No. The records that you have are of 5 years. Once you have provided those records that have been given for 5 years, you're good to go. Anyone who goes far much beyond that, that's a goon, that's a conman, and you should avoid such people. And you should register for that tax to avoid penalties and what have you. You should, as a business person, all receipts should be issued under eTIMS invoicing system. Claim your inputs, they save your money. If you are a small voluntary registration, you can claim for refunds from Kenya Revenue Authority, and they do. They do, because there is a law that provides that, and it protects you from that. So you can be able to proceed and do that. Perfect. I think we have covered a lot pertaining VAT. VAT under the Kenya Revenue Authority, there are stringent measures that they have proposed and which has served as an improvement. That is pertaining filing. They have introduced something called auto-populated filing of VAT, where you by logging in on the system, you will just go to file tax, go to VAT obligation, then apply. Once you apply, there will be something in black that is called auto-populated. Download that one. As you download it, it has 3 areas. One, it has an area where they have put 2 files in one zip, then one is unzipped under the zipped file. In the one that I have put 2 files, there is one with inputs that you received in your business, then there is another one with outputs that you gave out of your business on sales. You will be able to just take the main ledger that is used to be able to file the tax. Then once you have it, you will go to respective places where there is a inputs. You will just you will save us the ones that you've been given on that auto populated tax, then import automatic. You go also to the sales, you do the same, you import automatic, then you validate. Unless you have sales that you've done to a person who is not VAT registered, you'll just add by your hand, then you proceed to validate, then go back to the system, then upload. Say I agree to terms, then your filing is done. That is how VAT is easy currently to be able to be filed. And that is a shout out to Kenya Revenue Authority for having undertaken that. We only propose for more and more vigorous changes to be able to facilitate an easy way of being able to file tax and being able to make it easier for anybody who wants to file tax to file it in an easy way, and most probably in a good way. Anything VAT, we have agreed charged at 16%. Zero rate is at 0%. Exempt has no charging. An important note, I can't not see an important note to touch on it, unless anybody has a point of interest that he wants us to be able to capture, to be able to talk about. We will be able to come there. Filing, there is a difference between filing and paying. You file on 20th of every month. Then once you file, you have to pay before 5th of the subsequent month. Failure to which it is charged with interest. The date that you have in your system, you are charged with interest. So we are saying you file on 20th of every month. For example, VAT for December this year, you will be able to file it on or before 20th of January 2026. For January, you will file it on or before 20th of February 2026. So the subsequent month, you are supposed to file on or before. Then under the ETIMS system, it just functions like an ERP system where you cannot sell what you don't have. So you must first have the items registered in your ETIMS registration. Then once you have registered them, you can be able to come and now issue a receipt. And under ETIMS system and ETIMS registration, there are 3 ways of you registering your ETIMS. You can be able to register your ETIMS via online, where you will log into your ETIMS system through an online system. You can be able to register your ETIMS system through a gadget. That is the POS systems that generate receipts. So you can be able to register, or you can be able to integrate it with your ERP system. And there are a lot of ERP systems providers that offer that solution to you. Then you can be able to register your ETIMS or have that ETIMS ERP. It is just like an ERP system. You can have it on your phone. It can be registered on your phone mostly, or a laptop. And mostly on laptops, it is only HP laptops. For Apple laptops, you will not be able to be sorted. Also, even for iPhones, it will not be able to be done. So those are some of the reforms that we are calling upon Kenya Revenue Authority. And for that is online, you are advised that if maybe you have invoices that are exiting 10 invoices in a month, you will be able to be migrated to, maybe you attach it to a gadget. So they will be, we advise that they improve on that and see what to do, because currently life has gone online. You can also be able to issue Kenya Revenue Authority receipts via e-Citizen. But for e-Citizen, the tax obligation of VAT will not be able to be captured currently as it is. So I don't know if they have worked around that or if they are working on that, but we encourage that they can do better. That is it for now, ladies and gentlemen. We thank you for giving us your time, for listening to us, for giving us this opportunity. Just subscribe to our channel. We will be able to bring you this and exclusive content. Thank you. This is the Malemo conversation space. We have had a good conversation, a free conversation, a conversation not nurtured with feelings, but a conversation for knowledge, touching on one, two, but at one point, it gives us information and it leads us into knowing something that we didn't know. It is a bye for now. We meet next time. Bye bye.